Hey guys, happy Friday. In yesterday's video, I went over some study tips and my study sheet for the Series 65 annuities section. And then in a live stream in the evening, I attempted to take a quiz on annuities and insurance and realized that I had not read the chapter on insurance and suitability. I had been so concentrated on annuities that I neglected to finish reading the last bit of the textbook in that section. So today I read through that, insurance and suitabilities, which is follow-on topics to annuities. And I put together my little written down study guide here, which I'm going to go through with you guys. While I have heard of all of the products that are in this slide deck that we're going to go through in the next couple minutes, I probably did not know them well enough to pass an exam. And we saw that on a couple of the test questions that I missed on the quiz last night. So, for my sake and for yours, if you're studying for the Series 65, 66, the Series 6, Series 7, let's go through insurance and suitability to tag on to the presentation yesterday on annuities. And these three things together kind of encapsulate one small topic that could come up on your exam. The 5 categories we're going to be looking at for insurance: term life, whole life, variable life, universal life, and universal variable life. Each one of them have certain things in common and they have certain differences, and you will most often be tested on understanding both. What is the definition of these, and then how do they compare and contrast to each other? Very tricky questions, so you got to be ready for anything. And this does also require a fair bit of memorization. So write it down if you're trying to prep for the test. Make that your study sheet, and or print this out, this little guide that I put together, or go sign up for Achievable, link down in the video description. That is what I use for my textbook. This is extra work that I put in to make sure I memorize things that need a little bit of extra drilling into the memory bank. Term life, most of us understand what that is. It is the most inexpensive insurance option, and it covers a set period of time, 10, 15, 20 years. Typically, you're going to get that if you're young, maybe young and married, and you've got a beneficiary or a kid that you're wanting to make sure are taken care of if something happens to you, and you're just looking for something inexpensive to cover that certain period of time. If the policyholder were to pass away, the beneficiary gets the death benefit. And if the policyholder survives the term, 10, 15, 20 years, then typically the insurance will expire, although if you're young enough, you might have an option to renew it. Here are some of the key things to make sure you remember regarding these policies: premiums, the benefit, the cash value, and is it a security? On a term life, premiums are fixed. The benefit is fixed. The cash value, there is no cash value with a term life. There's a death benefit, but no extra cash value that you could withdraw or borrow from. We'll talk about that in some of the other insurance categories coming up. Is term life a security? Is it regulated as a security? It is not. Moving on to the next step up from term life would be whole life. And everything that we're going to cover from here, excluding term life, will be policies that could potentially cover a policyholder's entire life. Whole life covers the entire life of the policyholder as long as the premiums are paid. It also builds a cash value, and with whole life, that cash value is contributed to the insurance company's general account versus a separate account, which occurs in variable products. Recall back to the more robust discussion we had on this yesterday when we were talking about annuities. So the contributions go to the general account. The rate of return is fixed on the growth of that cash value. And one extra benefit of a whole life policy is the cash value could be withdrawn or borrowed from during the lifetime of the policy holder. And if you did withdraw or borrow any money, that would be subtracted from the death benefit. Any distributions withdrawn or borrowed would be taxed above the basis as ordinary income. The bullet points to remember beyond that: the premiums, just like with term life, are fixed. The benefit is fixed. It does have a cash value, which makes it different than term life. It is still not a security. And look at that second bullet point up there. The money is for the cash value is going into the general account. That means it is not a security, and the insurance company maintains the risk, not the policyholder. So our final line on this slide: the risk for this policy is on the insurance company because they are investing the money that goes towards the cash value of the policy. If the policyholder stops making the premium payments, there are about 4 different things that could happen. They could keep the death benefit for a shorter period, using the cash value to transition and purchase the equivalent of a term insurance policy. They could retain the insurance with a lower death benefit. They could surrender the policy and receive cash value subject to any withholding for surrender fees, or they could perform a viatical or a life settlement. And think of that as for someone that is older, maybe they have end-of-life medical care that is going to cost them a lot of money. They could, in essence, sell the value of their whole life policy to a third party. Let's say you had a $500,000 policy. Maybe this third party buys it from you for $300,000. You get $300,000 cash. The third party then would become the beneficiary of your policy, and they would also be responsible for making the payments for the remainder of the policyholder's life. So policyholder gets cash immediately to take care of whatever end of life expenses they have, medical needs, but they do that at a discount, and the third party, upon the death of the policyholder, receives the death benefit. Next up, we got variable life. Like variable annuities, there are some key things you need to think about when you hear the word variable. Like whole life, it does cover the whole life of the policyholder as long as premiums are made. But the difference being with this word variable, the cash value contributions are contributed to a separate account, not the insurance company's general account. That means that the policyholder, you or your client, maintain control over how those funds are invested, and you also have the market risk, not the insurance company. Remember, when we have that word variable and we know that it is kept in a separate account, that also is a reminder that this is regulated as a security. It's considered a security. Cash value, withdrawal, borrowing, and distributions are similar to whole life. Remember this, remember this, remember this. Variable life has fixed premiums. That is likely, might come up on a test question. There are some premiums that are flexible. Variable life, don't get confused by the word variable. It's still a fixed premium. The benefit may grow or decline. That is what might vary. And typically the insurance company will give you a minimum guarantee. So you're investing the money in a separate account at the insurance company. Depending on how the market does and your investment choices, the value of that cash might go up or down. So your benefit may grow or decline, subject to a minimum guarantee. We got 2 left. Universal life is the next step up. It is similar to whole life, except related to the premium payments. When you hear the word universal, I want you to think flexible. So the premiums are flexible with a universal life policy. A universal life policy builds cash value with the contributions going to the general account. We don't see the word variable in here, so the money goes into the general account. The insurance company has the market risk, not the policy holder. For those reasons, this is not regulated as a security. And then the final life, one step up from that, would be the variable universal life. Just like the one we just talked about, except now we have the word variable added to it. And again, a reminder, like we have been trying to remember, If you see the word variable, that means that the money is going into a separate account. The portion that is covering the cash value. It is regulated as a security, and the policyholder maintains the market risk, not the insurance company. And because we have the word universal in here, remember that is flexibility, so the premiums are flexible. Remember that term, whole life, and variable have fixed premiums, but when you step up to universal or variable universal, then you get flexible premiums. I thought I'd put one extra slide in here, just a little bit of extra information, because we did not really talk about this in the annuity video yesterday. What do we mean when we say an annuity or an insurance product is a security? Remember that word variable and the separate account. When the investor has direction and control over how the money is invested in the product, then it is considered a security, and the policyholder or the investor is subject to the market risk. Because of that, it is considered a security. The product is subject to registration and security regulations. The other thing that it means is that if you are an investment advisor advising people on these variable annuities or insurance products, you are going to be subject to extra licensing requirements, both from FINRA and your state. So that is the main bullet points to remember when we're talking about the difference between the annuities and the insurance products that are securities and are not. You might need extra licensing to be able to sell or advise on all of them. The final topic that we're going to talk about in this video is suitability. And the suitability is a quick 2 slides. So we can talk about suitability of clients for annuities and insurance. Let's just go ahead and knock this out. And that will cover every topic on the insurance portion of the exam if we count today's video plus yesterday's on annuities. Key points for annuity suitability for clients. An annuity is generally not recommended as a primary retirement plan. For primary retirement, we have 401k, 403b, IRAs, all of which tend to provide better tax benefits, more flexibility, and lower fees. Annuities are best suited for those wishing to supplement beyond those other types of retirement plans and potentially have retirement income. Refer to that annuity video for more details on that. Suitability of annuities is also more towards those who are not worried about taking care of beneficiaries. If you are worried about taking care of beneficiaries, then you might want to consider an insurance product. So let's talk about life insurance suitability. Key things to remember, 3 simple bullet points. They are suitable for those who need to support beneficiaries. The term life insurance, which we recall is the least expensive one, is most suitable for those seeking an inexpensive choice for a specific term, a certain amount of time. The other products, whole, universal, and variable, are more suitable for those seeking coverage over their entire life, not just a certain term. If someone is concerned about inflation, then you might want to consider a variable policy so that they can invest that money in hopefully a fund that grows their cash value faster than the rate of inflation. If their concern is more related to the growth rate, then you might want to direct them to a whole or universal policy. That is all I have for you on today's video, talking about insurance and suitability of annuities and insurance products. I'll probably do a quick live stream again tonight and take the insurance exam live with you guys one more time. Keep an eye out for that. I look forward to doing that live with you guys and answering any questions that you might have. I'm Tony Denaro, and I will see you on the next video.